Welcome to Legacy Sips and Tips podcast with your geeky host, Lindsay Wheeler, where we talk about everything from death, preparing for your future through estate planning, life, the occasional breakup, entrepreneurship, general nerdery, and of course travel, snowboard, and always wine. Welcome to Legacy Sips and Tips with your host, Lindsay, and today we're going to talk about the exciting world of inheritance tax. Yay, taxes! Because there's only two constants in life, death, which we know we deal with here, and taxes, and hopefully some good wine. When it comes to estate planning, understanding how estate taxes or inheritance taxes work is important. Honestly, most of us are not going to have that problem. I'm working really hard on that problem, but I like to spend my money a little too much. But we'll go over why most of us will not going to have that problem, but we should all be aware that there are these things in place called inheritance tax, whether that's federal inheritance tax or your state inheritance tax. Why I say that most of us will not have this problem, or that we should all be working toward having this problem, is that the federal inheritance tax as it sets now at this date is around $12 million. And that's at a step-up value. So your loved ones or your people who are going to inherit it from you are not going to be taxed on up to, it's a little bit over $12 million. So say, for instance, you have $14 million that you're going to now transfer to your loved ones. Well, again, that inheritance tax, for example, is going to be set at 12. I think it's 12.92 to be exact. They're not going to be taxed on that full amount. They're going to be taxed on what we call a step-up value. So you have $14 million. The exemption is, say, example 12. Your loved ones are only going to be taxed on that $2 million above the 12 to that 14. So that's why it's called a step-up value. So keep that in mind. However, there are 17 states, including Washington, D.C., that also impose a state inheritance tax, and this is where we usually find issues at that point. Again, federal inheritance tax, the federal government does not impose a blanket inheritance tax. It determines it based on the overall value of your estate before it is distributed to any of your beneficiaries. And again, it's a pretty high mark, meaning that the tax is only assessed on that amount above that mark and at a step-up value, okay? Again, it's important to note that this will fluctuate with administrations. Whoever's in office will either raise it or lower it depending on, but let's be real, people in Washington also want to keep their money, so they're usually going to keep it pretty high. It's not going to drop below $1 million like it used to in the 90s. It's just not going to do that. They're going to keep it high. Whether that's 10 million, 5 million, 6 million, whatever it is, most of us are going to be A-okay on that one. Where we really come into a problem is with that state inheritance tax. And if you're in one of those 17 states, including Washington, D.C., this is where you need to be aware of when you're transferring your assets to your loved one. There's a great Wall Street Journal article on this. I will click it, put it in the show notes where you guys can take a look at it. It really explains things really well and where issues became prevalent for these families that are highlighted in this article. So I'm going to highlight that article a little bit for you guys here so you kind of get the gist and understanding how this works. So while the federal estate tax hits only the wealthiest of Americans, because again, looking at that 12 million mark, the threshold for state estates, I like that, the inheritance tax are generally much, much lower. And these taxes can cost your heirs or beneficiaries tens of thousands of dollars that they were not expecting to pay, along with the grief of figuring out how to pay your bills, deal with everything after you've passed away. It's problematic in a lot of ways. The reason why this becomes a problem is because of the high increases on those property values. Obviously, most of us are not going to be able to buy a property in our lifetime. Because let's be real, who's going to buy a house these days with our cost of living increases that are not being commiserated with our wages, and now property values are insane. So, for example, in this article, we talk about a guy named Mr. Yi. He was about to have to pay nearly $112,000 in Massachusetts for the tax bill of his late mother's estate when he got, luckily, a reprieve from the governor. There was a retroactive change to the state's laws that had dropped the estate bill to only $12,000. He was very happy because also you don't want to lose your family's homes, too, for this, having to pay these crazy state taxes. So as families like the Yees often learn too late, the state tax rules are complicated and subject to change, as of all laws are. Again, 17 states, including the District of Columbia, have a state tax and inheritance tax, or both. So generally, your estate will be subject to these taxes if you consider one of these places your permanent home and you have property there, or your loved ones have property there. So double check where your parents are living. So estate taxes get levied at a rate of around 20% on estates over a certain threshold, known as the exemption amount in certain states. That estate tax exemption amount varies from 1 million up to that 12 million or whatever the federal threshold is. And those taxes will vary slightly from those states to states. Also to note that they're not levied on the estate, but to the heirs. So that's what's kind of crazy. So it's not being taxed particularly on the estate itself, but it's on that transfer to the heirs. So the heirs are paying it, not the estate itself, if that makes sense. The much lower exemption amounts and tax rates depends on the heir's relationship to the deceased as well. So parent-child usually is lower if you're going out from there because you didn't have any children or they didn't have children and you're a sibling, you're a cousin or whatever it is, those amounts might be much, much higher. Sadly, unmarried partners typically will pay the top rate. In New Jersey, for example, if you leave your estate to a niece, nephew, or unmarried partner, they are taxed at 15% on assets up to $700,000 and 16% on the assets above that $700,000 mark. There's no estate or inheritance tax when assets are left to a spouse who is a U.S. citizen, however. So that's helpful because we don't want to, have our spouses be out in the cold or having to pay these estate taxes. So at least we got that going for us. But if you decide to not get married because, marriage is a racket, let's be real, then you could be really at a disadvantage, unfortunately. The threshold for an individual to owe federal estate taxes right now is $13.61 million in 2024. In 2021, the statistics are 2,584 estates paid more than $18.4 billion, that's billion with a B, everyone, in federal estate taxes. And only one state, Connecticut, matches the federal threshold. So that's crazy that there is so much wealth out there for, in 2021, 2,584 estates. That's not very many comparatively to all the people who have died in the world or in the U.S., is $18.4 billion. Governments and state localities are like Yahoo. So unlike the federal tax, the big share of the state tax, inheritance tax revenue does not come from just what the wealthiest families, but now are coming from a large number of smaller estates subject to this amount. So the estate tax wasn't on many people's radar, including this family that's highlighted in this article, the Yi. He said his mother, who worked as a union seamstress, and his father, who was a cook at a Chinese restaurant, immigrated from China when Mr. Yi was 8 months old. When his mother died in January at the age of 93, good job, good, nice, long life, she was still living in the family's home that her husband and her bought together in 1970, and they bought the house for $43,000. We're not even going to go into the cost of living changes and inflation, because we all could do that math. The house is now appraised at $2 million. Crazy, right? 1970 home, $43,000 to now 2024, $2 million house. Plus her bank account balances put her estate in Massachusetts in that estate tax territory. Mr. Yi and his sister are working out a deal to buy out their other 3 siblings' shares so they can stay in the house because that's a family home. They probably grew up there. They have good memories there. That was their parents' home. They don't want to get rid of that. They don't want to sell that because they have to pay some tax. And he says that people are caught off guard, which is, people aren't aware of this. So this is why we're talking about it today. So when states change the threshold, so luckily, thankfully, in Massachusetts for the Yi family, the bill dropped, but the state changed and softened its estate tax bite, as they say here, doubling the exemption from 1 million to now 2 million. So again, we talk about that step-up value or that tax assess on that. They were not able to have the exemption on that $2 million house plus those bank accounts. It was well above that 2 million. The only state exemption at that time was $1 million. Now they've changed it to 2, so it's reduced that tax liability, thankfully. However, that leaves Oregon as the only state with a $1 million threshold, which I don't know about you, but where I'm at, I can get a pretty rinky-dink tract home for $650,000. That's insane to me. So maybe you got that, you have a couple of, inheritance accounts, if you will, or vehicles, and you're at that 1 million threshold at this point. You're going to be paying taxes on that. And that's just for us basic people who have a basic tract home, basic assets. So always check what state you're in and making sure that you can helpfully try to avoid some of these tax implications. So in Oregon, it's at 1 million threshold. It's the lowest in the nation. Its legislatures passed a law retroactive to the deaths as of July 1st that exempts up to 15 millions of a farm, forestry, or fishery properties from that estate tax. So they want to make sure that people who are using the land or farming the land are having an exemption on that to keep that going. Because again, they don't want to have to sell the family farm, no pun intended, to pay for this silly estate tax. That provision would have knocked about $100,000 off the estate bill for a client in that state who had a 60-acre fruit orchard that was left to his son later that year. And many of the other states, those 17 states, are also changing the inheritance tax rules just because of the cost of living and property tax, property values, if you will. Other states' inheritance taxes, so if you're in Iowa, it's phasing out its inheritance tax after January or December 31st of this year. Nebraska reduced its top inheritance tax rate to 15% from 18%, effective of this year, and eliminated taxes for heirs under 22. So, God forbid your parents pass away when you're 21, you're not going to have to pay that, inheritance tax on that. It says efforts are underway to get a question on the 2024 ballot asking voters whether they want to ditch the tax altogether, which I'm sure most people will want to. For example, a state attorney in Nebraska is handling an estate for a mail carrier who died last year and left his farmhouse to his college-aged niece and nephew. They had to take out an additional loan on the house to pay the $40,000 inheritance tax bill. They are now, unfortunately, having to sell that property, which they really didn't want to, because now they're stuck with this $40,000 bill. And they said, it would have been great to keep this house that their great-grandparents owned. And now they're being forced to sell the family home that they probably grew up and had great memories with because they're stuck with this crazy state estate tax. So how do we avoid that, or how do we plan for those state estate taxes? One, don't live in those states. I know, easier said than done. Just kidding. But, that is an option. Moving is an option. If you live in a state with that estate tax or expect to inherit from somebody who does, here's what you need to know. So watch out for that estate tax amount. In New York, when the estate's value is higher than the exemption amount, the effective tax rate on the excess value is quite extraordinary in New York. This attorney here who is working with clients says that an estate valued at $6.9 million, 5% above the $6.5 million New York state exemption amount would be around $626,000, which is crazy. And then they have a 9% effective tax rate, but a 190% marginal rate on the excess. So if you're above that, you're paying an exorbitant amount of money. So maybe not live in New York. I know. New York's a fun place, though. For states near that so-called cliff area, taxpayers can give away assets to reduce the value of their estate before death. I see that happen a lot where people are like giving gifts away or putting it into, funds, or helping loved ones with their in retirement investments, buying homes for them in their states that don't have this, what have you. You can put also that maybe in their will or their estate plan that any amount in excess of the exemption amount would go to charity. That will avoid that because it'll reduce that amount. In Illinois, they have a similar cliff amount at $4 million, and the new Massachusetts law eliminates its cliff altogether, which is why the savings of the YEE was so dramatic. So they were able to reduce that by half because they basically doubled the exemption. Check for those inflation adjustments. Some states, like Rhode Island, which has a $1.7 million exemption, increase the threshold each year in line with inflation. So that cost of living, they will adjust that for people. That helps keep more of the estates below that threshold, luckily, as the estates grow and inflation grows, which is exponentially right now. In other states like Illinois, at $4 million, the amounts are static, snagging more states as asset values rise. So that $4 million does not get adjusted. It is just set at that amount. So be aware of that. And like the example of the Yees, they didn't have anything crazy. It's just that those property values had increased so much from when they bought the house in the 70s. It's a basic home, maybe 4 bedrooms, 2 baths, very small, nothing crazy. Had shot up to $2 million in values, and that's where they got stuck with that estate tax. Non-residents can also own that estate tax. So again, be aware that if you live in a state with no estate tax or inheritance tax, but own property in a state that does, you can still be on the hook for those taxes, or your heirs can be on hook for those taxes. For example, this attorney just completed one in Oregon. He did an estate attorney for a Nevada transplant who kept investment properties in his former home of Bend, Oregon, which they have really high prices now. Bend is an amazing place to live, frankly, and great skiing there. Good. Deschutes is right there. They have Bachelor is right there, and it's super fun resort, everyone. That's a side note. The investment properties were shielded from Oregon taxes because they were held in a limited liability company, and we'll have an episode on how to help mitigate some of those taxes or liabilities with putting your properties or your rentals into an LLC. The son, who was an executor, was surprised that he had to pay the Oregon estate tax of about $65,000 on that $640,000 home, which was not put into that LLC or did not have any kind of tax planning or estate planning done to that property. So that's a big one. And again, you can move out of state. The ultimate move is to avoid that estate tax by moving. For example, Jeff Bezos, we all know him. He's so special. He recently said that he is relocating from Seattle to Miami, which could potentially shield his heirs from the Washington state estate tax. That's why he did that. Luckily for us in Nevada, we do not have an inheritance tax for our state, which is great. And a lot of states are phasing out that state inheritance tax or making significant changes to help ensure normal, everyday people who have worked really hard to accumulate some wealth can pass it on to their heirs. Generational wealth is what we like to create, so their loved ones are not having to pay that high tax penalty. And of course, I'll link all of these in the show notes for you guys to look at. You can look at the different states that have the estate tax. I need to slow down when I say that. And I can show you some of these here and talk about them. So, Connecticut, Washington, D.C., Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, and Washington are the main ones who have that estate tax. Some of those exemptions, Connecticut has the highest one of $12.9 million. D.C. has 4.5, Hawaii is at 5.4, Illinois at 4, Maine at 6, Maryland 5, Massachusetts real low at 2, Minnesota pretty low at 3, New York at that 6.5, Oregon extremely low at 1, Rhode Island also extremely low at 1.7, Vermont at 5, and Washington state pretty low at 2.1. And then just keeping that in mind when you're doing this, always check your jurisdictions and make sure that you are doing your estate planning correctly, and tax planning as well. Always work with your financial advisor, of course. Today's wine we are featuring is another Napa wine. I'm on a Napa kick lately, which is funny because I don't really particularly like Napas, but apparently I do because I'm drinking a lot of them. This one is a 2013 cab from Stag's Leap Winery, which that's a very famous winery out of Napa region. It's 2013. It is a great wine, typical Napa cab, big, jammy. It's got those good fruit in there, cherry, blackcurrant, little pepper on the back end. So very nice wine. This is a very, very nice wine, actually. So if you have questions or if Stag's Leap would like to sponsor me, I'll take your wine all day long. So thank you. So as you guys are aware, if you're any of those states have that state inheritance tax, let me know. We can discuss that, or we can help you guys, pre-plan, or help your parents pre-plan or your loved ones pre-plan to hopefully try to avoid that. And we can look at what those are. So always just be aware of your state and your jurisdiction, because these are things we don't think about. Like the example of that family, the Yee family, they just think, oh, we have a very basic home. It's really not worth all that much. Obviously, it's worth quite a bit more than when his parents bought them, but they were normal, average workers. They were immigrants from this country. They worked hard. She was a seamstress. He worked at a restaurant. It wasn't like they're in tech or something and they've got, hundreds of billions of dollars, anything like that. They're just normal people who now have then saddled their children with this crazy state tax that would probably potentially force them to sell that property and have to give up their family home to pay state tax. So ways to avoid that. If you have questions or concerns or have any horror stories of your own, let me know. And of course, when you think of death, think of me. Thank you for listening to this podcast. If you found value, please like, subscribe, and share. And be sure to follow me on all the socials at Sips and Tips with Lindsay. And of course, you can always go to my website, sipsandtipswithlindsay.com, to find more information about estate planning, business, snowboard, travel, and of course, wine. As always, we have to get the legal stuff out of the way. I went to law school, so you don't have to. However, we have to read the special disclaimer that I am not a practicing attorney. I am not your attorney. I am not offering any legal advice in any content or any episode. All content is for your information and educational purposes only. It is not a substitute for seeking your own legal advice from your own attorney or other professionals such as a CPA or financial advisor. I cannot give legal advice and do not offer any legal services or legal advice, but I do offer some fun and educational content for you to enjoy.